With me now is Capital Network's Ed Stacey. Ed, good morning.
Good morning.
Just a reminder, for Ed's full report, click on the eye in the top right-hand corner of your screen. Some interim numbers out this week, Ed, from H&T. A decent set of results here?
Yes, H&T Group results, yes, they were strong. 11% PBT growth, profit before tax. That's come from really all of the main operating segments, so good sort of spread of the growth drivers. And also the results present pretty favourably on the risk metrics. And that's important to us because I think it's an aspect that's really underappreciated. This is basically a low beta, low cyclicality type of business. And I think that should really be reflected more in the valuation.
I suppose give us a bit more detail here, Ed, on the risk profile at H&T.
Yeah, we wrote about this a lot in our initiation report a couple of months back. The core pawnbroking business is fundamentally a fairly low-risk model because pawnbroking is secured lending and they tend to pretty much always recover the full value of the loan. And it's a business that grew right through the financial crisis, 2007 to 2010. Profits kept growing. And then as we look at the sort of specific risk metrics now for H&T, you have redemptions are high at 85%. That's what percentage of pawnbroking customers end up coming back and repaying their money and reclaiming their goods, 85%. Low leverage on the balance sheet. The net debt to EBITDA is less than 1 times. There's not a lot of leverage there. And then when we look at one of the other big business units, the personal loans business, so that's unsecured loans, but it's been expanding more into lower risk loans. They've got 54% of the lending now is into the non-high cost short-term credit sector. So they're getting out of that high cost short-term. I mean, it's never really focused on that. There's a lot of the lower risk lending. So you're getting that 11% PBT growth, but it's not coming at the expense of taking on a lot of risk to the business or risk to the dividend payouts.
Shares, of course, have dipped in the last couple of months, Ed. A possible buying opportunity here, you reckon, for investors?
Yeah, I think that's the way to look at it. The share price weakness in the last 2 months, I think maybe it reflects some sort of macro weakness on the UK high street. Maybe also it's to do with the IFRS 9 accounting. So these H1 results, they reflect the new accounting changes. These are changes that affect everyone, not just H&T. The company published some details of those accounting changes back in July, but I think maybe that did have some impact on the share price in terms of how it's brought the earnings numbers, reported earnings numbers lower. But where the shares are now, you're on a 10.7 times PE multiple, and you've got a 3.4% dividend yield. And so I think this, in valuation terms, it looks like an attractive entry point because this is a growing, profitable business, growing the profits, low balance sheet gearing. And so, yes, I think on a dip in the share price like you've had the last couple of months, I think it's got to be interesting on these kind of valuation.
For Ed's full report, click on the eye in the top right-hand corner of your screen. Ed, thanks for your time. Good to speak to you.
Thanks.